In this episode, I continue the discussion on policy illustrations that we started last week and dive into a real policy illustration to help you fully understand what's going on inside the illustration and how to put all the numbers in their proper perspective. I'm Nate. I help people make sense out of money. This is Dollars and Nonsense. If you follow the herd, you will be slaughtered. All right, everyone, welcome back to the show again. We're picking up really right where we left off last week. If you can remember the last episode, we discussed all of what I believe are kind of misconceptions that people bring into the discussion when they start actually looking at policy illustrations. A lot of people want to see the numbers, and I understand that. They want to get, what's the product look like? What's the best product to use? What do policies look like? And illustrations do a good job showing that, but I think we bring some stinking thinking into the policy illustration discussions. And so I really, last week, I went into the three main areas that people get kind of off base with policies. They think that the illustration will show them things that it can't show. Like they think that a policy illustration will show them what policy is better than another. And unfortunately, it really can't do that very well. They think that policy illustrations will tell you what company is the best to work with. And unfortunately, once again, it doesn't do a very good job at doing that. So go back to the last episode to see that. We also think a lot of times that maybe policy illustrations show what the company actually thinks that the policies are going to do in the future. Like it's a projection of what they think is going to happen. But that's actually not the case. A policy illustration just shows what is actually happening right now. And they're not really trying to say that you should expect it to be exactly the way it is now in the future. There's a lot of things that are outside of their control that will determine that. A lot of it has to do with interest rate environment. And the number one flaw, which we have to keep in mind the entire time I'm about to review the policy illustration, the number one flaw is that whenever you're trying to implement the infinite banking concept, an illustration does not show you what it's like to implement infinite banking. All it does is really show you, if I pay premiums, what kind of cash value do I receive? And this is where things get derailed the most easily, is when people essentially use the illustration and look at the numbers and see if the numbers are good enough. Like, in other words, they're thinking of it like an investment. Are the numbers good enough for me to do this, or should I just do something different? And what we're saying is, once again, remember, you're not using the policy as the investment. You're using the policy to build a banking system that can be used to fund investments. But the question that lies before all of us is, do I want to build a banking system? And then number two, what's the best way to build up a banking system that I'm in control of? And we feel that infinite banking and becoming your own banker presents, through these policies, the best route. It's not saying the banking system is the investment. It's saying it's the best place to do banking in. And that's, of course, for more details on that, you'll want to listen to the rest of the other podcast episodes we've been doing. Let's go ahead and dive into an actual illustration. My goal in this time is to review a policy illustration for you. I know that I'm going to have some people listening to the audio only while they're driving, so I'm not going to dive too much into the numbers as crazy as I could. I'm trying to make sure that everyone can understand whether you're watching it on YouTube or listening to it in the car. Let's go ahead and dive in. Essentially, the goal of this episode is to really share what I think are, first off, how to read a policy illustration. I think is very important. But then secondly, you really want to get to the point where you're putting them in the proper perspective. Like what are the real things that I'm trying to gather when I review the policy illustration? So what I did is I built out kind of a basic policy illustration here. Just a basic policy. I didn't do a whole bunch of odd things with it. I didn't put any sort of bells and whistles on it. Not that I normally do per se anyway. But this is kind of just a basic normal way to build out an infinite banking policy. And as you'll see, there's a lot of columns on the page. If you're listening to the audio only and you've seen policy illustrations before, you know that there's a ton of columns on here. It's a huge wall of numbers inside of a policy illustration. Doing infinite banking, though, we don't care about very many of them, by the way. The key numbers that we care about on any policy illustration are, what is the premium amount that I'm contributing? So that's this first column here, the total premium. What is the cash value that's accumulating in the policy? And then we like to just understand and realize the fact that we do have a death benefit. We're not going to put a lot of, we're not going to accentuate it thoroughly. I think it maybe gets underplayed a lot of times, but that is a fun number to keep in mind of. So really the main columns on the entire page that are most important are how much money am I putting in, what's the cash value, and how much death benefit is coming with this policy. So in the example, we're assuming we're starting essentially a $50,000 policy. Now, I've brought this up many times in the past. What exactly does a $50,000 policy mean? What does a $50,000 policy mean? This goes back to a couple of things that I think the illustration does a pretty good job showing that we've talked about in the past, just in various other episodes. Mainly that whenever what we call a $50,000 policy is essentially a policy where you're funding at $50,000 and the MEC limit for that policy is relatively close to $50,000 as well. So how that really plays out in reality, for those of you who have been listening for a long time, you probably already know this, but inside of every policy, there's essentially a window being created that you are allowed to contribute to. At the top of the window is the MEC limit, and at the bottom of the window is what's called the base premium. And how you fill up this window each year is through your paid up additions rider, or your PUA rider, which is a flexible piece to the policy. What's really nice about policy illustrations, of course, is that we can see this happening in real time. But once again, there's some confusion that enters in too. So in this example, we show someone contributing essentially what we call a $50,000 policy is a policy that has a MEC limit of right around $50,000. And the goal would be, if at all possible, to try to max out the policy and fund the maximum MEC limit that you possibly can as long as possible. I mean, anytime you contribute, the more you contribute, the better. But it's always important, I like to take the time, especially when I'm reviewing policy illustrations, for everyone to understand that just because we're showing somebody contributing $50,000 for a period of time actually does not mean they have to. So that's one also interesting thing to bring up about policy illustrations is we can essentially illustrate any amount of money going into a policy, but you're not actually required to follow your original illustration. There's no requirement here. You are required to pay the base premium. In this case, the MEC limit's right around $50,000, and the base premium is $16,000 in this example, which means if the MEC limit's $50,000 and the base premium is $16,000, it assumes that we are contributing $34,000 to our paid up additions rider. Easy math, right? And what I was trying to bring up is just because we're showing someone on an illustration contribute $50,000, we always have to go back to the idea of having a window of ability, right? The premium paying ability that any given year I can put in 50, I can put in only 16 or the base, and I can put in anywhere in between. And once a policy is really mature and doing well, technically I can have the policy pay for itself and I don't have to contribute anything, which we just did a podcast recently on that very topic. I think it was episode 201 of our podcast, talking about how policies can pay for themselves, what happens if you can't pay a premium. So that's a cool episode too. So in this example, you'll notice that we essentially maxed out the policy and we contributed $50,000 every year for the first 5 years. I'm not required to do that. I certainly can do that if I want to, and that would be the goal. And then after year 5, I actually just illustrated the policy being reduced, my contribution, only contributing the base premium of $16,000. Remember, there's no requirement to do this. In fact, year 6 will roll around, and I do hope you have the ability to continue funding at $50,000. But the reason why I typically show policy illustrations this way with clients is because for the most part, anytime we're launching a policy and starting a brand new policy, you do want to contribute, if possible, up to the maximum that you possibly can, up to the MEC limit, typically for the first 4 to 5 years, to really launch the policy and get it profitable quickly. We wouldn't want to start a policy if we knew there was no way that you were going to be able to contribute much to your paid up additions rider. That wouldn't be a wise decision. Now, sometimes that happens. It just wouldn't be wise to start off with. So the reason why I'm showing 5 years of paid up addition rider contributions, essentially $50,000 a year for 5 years, and then dropping it down to 16, is mainly just to tell you the goal is to get the policy moving. The paid up addition rider is extremely important to stuff cash value into a policy, which we're going to talk about in just a minute. But once the policy is moving along, usually it happens around year 5-ish, the more paid up addition rider premium you pay, the better. I'm just merely saying it's no longer really required to make the policy perform well. Once we get the policy fully capitalized, it doesn't actually matter if I just pay the base premium or if I pay the maximum. The policy is going to perform very, very well, which we'll see here in just a moment. But just kind of to show you what's happening, by the way, in year 6, that's like a little bit of a sneak peek. We put in a $16,000 base premium, but the policy grows by almost $28,000. So in year 6, this guy puts in $16,000 and gets $28,000 of cash value. Things are going really well. He could have put in $50 and gotten money too. Of course, I'm just merely saying the policy is what we call fully capitalized. It doesn't need a whole bunch of paid up addition rider capital to perform well. It can perform well whether you continue the PUAs or not. PUAs are desperately needed to launch a policy. They're not as needed as the policy matures. The base premium actually becomes very, very efficient by itself. It doesn't need any paid up addition rider premium to go in necessarily. The whole goal of this episode was, how do I read this thing? What am I focusing on? Nate, you went through that whole episode last week and you said all these things that policy illustrations can't do. Well, what can they do? And what the illustrations do the best is they describe the window very well. Okay, here's the maximum premium, here's the minimum, and we can see that happening in the total premium column. So we know what we have. We know what the base premium is. We know what the MEC limit is. We know how much can fit into the policy. It's very good at showing you what that policy allows for you to do as far as how to fund it with premium. The next best thing it does is it describes a typical trajectory for the policy, which is the fundamental most important thing that it does. And remember, it doesn't do a very good job telling you which company is going to perform the best for the next 45 years. It doesn't do a very good job telling you which policy is the best over the next 45 years. It doesn't do a very good job telling you how you're actually going to implement the concept of infinite banking. It doesn't do a very good job in a lot of these different minor ways, like, it doesn't even do a very good job describing what dividends are actually going to get paid. We don't really know. Some of that's outside of the insurance company's control. But what it does do is present to us a typical trajectory for the policy in general. And so by the time you get here, hopefully you've already taken our beginner's course or read Nelson Nash's book or something of that sort that has given you an idea of what policies are going to do before you even get to your own illustration. So nothing should come as a surprise at this point. It should just be kind of confirming what you expected to see would be our hope. But with that being said, it presents a good idea of what to expect when you get started. So like in this example, we know when we go into a policy that the base premium really doesn't build any cash value for the first couple of years. It's good to know this, and we can talk about that in the policy. So you'll notice in year one, we put in $50,000 of premium, but our cash value was only $30,500. Now, this is just an example, by the way. I really hope no one's looking at this and saying, this is my policy. Policies, there's a lot of different ways to build out policies that I'm not showing in this one example. But no matter which way you decide to build a policy, some things remain true. Like a base premium doesn't produce cash value early on in a policy. The majority of cash value comes from the paid up additions rider early on. And so that is why every policy that's launched, you'll pay premiums in the early years, but not all of it's going to go to cash value right away. We've always likened it to building a business. Is what we've always likened it. Like we're capitalizing a business. We don't expect the business to be making large amounts of profits early on. We're building the policy for a lifetime of profitability, not for some short-term focused profitability. It's certainly a long-term trajectory. So what's very important to understand when you get started is, of course, hopefully you know this before you even see an illustration, that I do not expect all of my premium in year one to go into cash value. And I don't expect that to happen in year two. And so in year one, we put in $50,000, we have about $30,500 of cash value to work with. Some people think by reading or watching videos or lessons that we can't use policies early on, which couldn't be further from the truth. That's actually one thing that we can learn when we look at a policy illustration, is that even in year one, I'm not profitable yet. The policy is not growing by more than I'm contributing yet, but I have every right to use my $30,000 in a policy loan and go start practicing this concept of infinite banking. Maybe I'm going to buy some rental properties. Maybe I'm going to pay down debt. Maybe I'm going to pay cash for a vehicle, or maybe I'm going to, I don't know what I'm going to do with this money. But that's one of the biggest downsides of the illustration, is that it gets people into investment thinking as far as the policy as just an investment opportunity and a safe place to store some money, as opposed to the best place to practice banking in, building a banking system. And so all I'm saying is what it doesn't do a very good job describing is, well, what am I going to do with the cash value? So we always have to keep that. We have to remind ourselves of that as we're seeing this, is that the goal is to build a profitable banking system that finances on my life, fundamentally. And then we can't show that here on these pages. All we can show is what happens if I just let the money sit and don't do anything. So understand that in year one, we put in $50,000, we have $30,000. We expect to use that as much as possible. We don't know yet for sure what we're going to use it for, but we're going to use it for some things. Maybe you don't have anything yet, but that's fine. Year number two is going to roll around, and honestly, it's going to be pretty similar to year one. And in year 2, once again, the base premium really doesn't produce much cash value, if any at all, in the first couple of years. All the cash value comes from the paid up additions rider early on. That's not the way it always works. That's only the case for the first couple of years. So in year 2, we went from having about 30,000 of cash value to 64,000 of cash value. So I paid my premium of 50,000 in year 2, and my cash value grew by right around $34,000 in year 2. Which means I've got another $34,000 to work with. It's a little bit more than the first year, but we're still not profitable by any means. We're going to get there, we're just not there yet.
Are you tired of feeling like everyone has their hand in your pocket? At Living Wealth, we believe in challenging the status quo. After all, most of those conventional tools only seem to make someone else rich. Let us show you how to take back control by banking on yourself. Visit livingwealth.com/escape the bank. You'll receive instant access to what we call the beginner's course. This free, in-depth, easy-to-follow course teaches people how to create and profit from infinite banking. We not only discuss the philosophy and principles behind infinite banking, but also offer real-life examples to demonstrate how it works. Even folks experienced with infinite banking often tell us they learned a ton too. So, it's worthwhile regardless of your experience level. Stop letting banks and Wall Street dictate your financial future. Again, that's livingwealth.com/escape the bank to gain access to the free course today. Now back to Nate and Holly.
Year 3 rolls around, and this is the year where the base premium starts to build some cash value. Sometimes you'll actually see year 3 be what the quote-unquote cash flow break-even year, or at least it gets pretty close. Normally in year 3, you'll make a contribution. In this case, it's going to be $50,000, and you'll usually get 90% or more of the premium going to cash value. And what we see that happening here. Our cash value in year 3 grew by right around $45,000. So I put in $50,000, I get $45,000 of cash value to work with. That's right around 90%. So that's the other thing. What is the illustration good at showing? Just a typical trajectory of a policy. Now, we're not totally for sure what dividends are actually going to play out to be in any company. So an illustration can't show us exactly what the number is going to be in 5 years of total cash value exactly, because they don't know exactly what dividends are going to be. However, it's going to be really close. It's going to be really pretty darn close. Maybe it's actually going to be a little bit better. Maybe it's going to be a little bit worse, but it's going to be right in the ballpark. So what we can expect, especially in the short term, is that the policies are going to be pretty accurate as far as building out a typical trajectory. Like, what does a normal policy build out looks like? And from company to company, they almost always look right around the same. So in year 3 is what we kind of, in our trajectory, it's when things are really starting to gain steam in every policy. We should have been using the policy in the first couple of years, but it just hasn't even gained steam yet. The base premium part hasn't even started producing cash value. The reason why the base premium doesn't produce cash value in the first couple of years is because they're setting that money aside to cover the death benefit. And then after that, it starts to produce cash value really just like the paid up addition rider does. By year 4 of every policy is when policies really start to get exciting. And the reason why year 4 is such a fundamental year is because year 4 is typically the first year you see the policy making any sort of significant profit. So in this case, in year 4, we put in $50,000, and the cash value grew in that year by $52,000. So starting in year 4, year 3 we kind of think of as close to the break-even year as far as cash flow, not cumulative break-even, but just cash flow. Like I make a contribution that year, how much cash value do I have to work with? It's pretty close. It's normally about 90% or better of the total premium. But by year 4, normally speaking, is the first year where the policy enters a profitable stage. I just contributed $50,000 and the policy now grew by $52,000. I now have a profitable system. And what's really great about this is that from that point on and every year for the rest of your life, the policy is going to be making you a profit. So in other words, every time you pay a premium, you'll be richer than you were the day before. Every time you make a premium contribution to the policy, a premium payment, the cash value that year is going to grow by more than you put in. And year 4 is the start of a fun journey for the rest of your life. So you've paid your dues. This is why we love having mature policies. I have a lot of mature policies now. I love premium days. But year 5 rolls around, and in our example, this is going to be the last year that we contribute to the paid up additions rider. Remember, I'm not saying that you can't contribute after year 5. This is not a recommendation per se, but what I wanted to illustrate is, typically speaking, when we're talking about a capitalization of a policy, we want to shoot for 4 to 5 years of heavy contributions where we're contributing a decent amount. We're getting up to your MEC limit in the policy. We're getting large amounts of contributions stuffing money into the paid up additions rider to get the policy launched. It's like a rocket ship. It takes a lot of power and energy and fuel to get a spaceship or a rocket or something going, and it takes less for it to continue going. And that's the idea, is that once you've used the paid up addition riders like the rocket boosters of the policy, it's gonna propel the policy and get it moving in good shape. But we can keep the boosters on. You can keep funding them if you want to. It'd be great to keep funding them. It's just not actually necessary for the policy to perform well. So here in year 5 is the last year we're going to put in $50,000, and you'll notice the policy growth this year was right around $59,000. So we put in $50,000, and we've got $59,000 of cash value that we can borrow against and use to do IBC, which is really what we want. So this early stage of the policy is really where the illustration shines and produces the most value to people looking at it, just to set expectations, to understand what a typical policy trajectory for me would look like. It's not going to do the best job at comparing it from one company to another. It's not going to do the best job comparing long-term values. It doesn't tell us what we kind of wish it did at times to have an objective decision of which policy is the best. So that's what we wish it could do. It doesn't do that very well, but what it does do very well is give us a typical, normal-looking trajectory of what we can expect from year to year. By year 5, I put in $50,000. I've got $59,000 to work with. Now I'm in the fun stage. When you're in this stage, we really hope you stop ever thinking of the questions of, when can I turn off this stupid premium? I'm tired of this premium. Once we get here, where the premiums are supposed to be fun. That's why I've said many times, I like premium days. It's fun to pay premiums whenever you get past the capitalization stage of any policy, because now the policy is just going to continue growing by more and more and more every year. Any amount of money I put in, whether it's going to be $50,000 in year 6, even though I'm only illustrating 16, or whether it's only the base or somewhere in between, no matter what happens, I have a profitable policy and nobody can take that away from me. It's not going to go backwards in time to its early infant stages. We paid the dues, the business is profitable, and it will continue to be profitable into the future. Year 6, you'll notice, is the first year that we did not contribute to paid up addition rider premium. I'm not required to not contribute PUA premium. I was never required to pay PUA premium. I have a window that has a maximum limit of 50 and a minimum of 16, and I can fill it up or not any year I want to, no matter what's on this page. However, our goal for the first 5 years is to try to fill up the window as much as we can. After that, sure, keep going. It'd be great. But what I wanted to do in this example, though, is show, okay, what does it look like even if I don't continue max funding a policy? I just continue with the base premium from then on. Just to show you that the policy is really well funded, it's mature, it's capitalized, just like I did earlier in the example. In year 6, we pay only the base premium. We don't even contribute any paid up addition rider. I put in $16,000. That's all I put in, but the cash value growth that year was almost $28,000. It grew from $220,000 to $248,000 of cash value in that year. So that means I put in 16, I got 28. That's a $12,000 tax-free profit with no risk. I had $16,000 in my bank account. I wrote a check to the insurance company for $16,000 to pay a premium, and it just moved from my left pocket to my right pocket. And now I've got the $16,000 plus another $12,000 of profit that's going to make throughout the year that I can use to go do banking, to go practice the concept, to enjoy, and I don't owe any taxes on it. It's a very powerful tool, especially when it's used not as an investment per se, though it's a nice asset to own, but when it's used as, when you leverage the policy to actually practice the real concept we teach. And once you get to this point, and every year after that, it's pretty much continued on a normal track. There's no curveballs. It pretty much just continues on an ever compounding track, which means every single year I pay my premium, and every year it's growing by more and more than it did the year before. And so there's nothing new to expect. One thing that I'm sure you would have noticed, though, is that there's kind of one more thing that people like to see, though I've mentioned I don't actually ever keep track of. Well, let's just say this. It's the break-even point. We talked about year 3 being kind of the typical cash flow break-even point, where essentially starting in year 3, I'll make a premium payment, and my cash value will grow by really close to that amount. It may 90 to 100% of what I'm putting in at that time. So the cash flow break even is usually around year 3. The cumulative break even usually occurs somewhere around year 7 to 8. In this case, I think it's year 8. Somewhere in between year 7 to year 8 is whenever you'll see a cumulative break even point. And the reason why I say I don't really care much about this is because I've never once, I honestly have no idea. I've been doing this for 11 years now. I have no idea what policies have broken even, what policies haven't broken even, because to me, it's kind of a fruitless discussion in some ways. All I know is what they're doing right now. I know that this year, across the board, my policies are going to grow by around $40,000 to $50,000 above my contributions across the board on all. I have 11 policies. I've been doing it for 11 years. So I've across all 11 policies. Some of them I'm sure have broken even. Some of them haven't. I don't really know. I don't keep track of that because I think I wasn't doing it for some, hey, which year am I going to break even? It was mainly I'm doing this to build a business and it's going to be profitable. And I'm excited to have the profits. I'm going to make about 40 to 50 grand from my banking system this year, tax-free with no risk. I'm excited. Some of them have broken even, some of them haven't. I couldn't tell you which ones have and which ones haven't. I'm just guessing the oldest ones have and the newest ones haven't. Let's put it that way. But I do know that a lot of people think about that. And by year 8, in this example, is the year that the total cumulative outlay that we put in, the cash value exceeds that. In year 8, we had put in $298,000, and we have $309,000 of cash value. So right around somewhere in between year 7 and year 8, the cash value exceeded all. And so now the rest of it's just pure profit from then on. You'll also notice that our death benefit has dramatically grown over time. We started with 1.1 million, and now we're at 1.6 million. That's another good thing that illustrations can show, is that your paid up additions rider doesn't just produce cash value. It also accelerates the growth of the death benefit too. So the death benefit, every time I make a PUA contribution, it boosts my death benefit too, not just my cash value. And the dividend actually does the same thing. Whenever you put it back into the policy, it actually goes in as paid up additions as well. And so it boosts the cash value and the death benefit too. So you'll normally on a typical policy trajectory, not only will your cash value grow over time, but your death benefit will also grow over time. And sometimes we can even see, if I go down to the bottom of this page, this person is 65 years old. By age 65, he's still putting in just the base premium. He's put in a total of 570 grand by age 65. His cash value is 1,172,000. So that means he put in 570, he's got 1,172,000. He's actually more than doubled his contributions inside the policy with no tax and no risk. Hopefully he's been practicing IBC the whole time. His death benefit's now up to 2.3 million. But look at what the policy is doing. The policy is growing by right around $72,000, $73,000 every year at that point. So right now the growth of the cash value is let's just call it $72,000. It grew from 1,999,000 to 1,172,000 for those of you just listening to the audio. And we only put in $16,000 that year. So if it grew by 72 and we contributed 16, that means that we made a net profit of $56,000 in that 1 year, tax-free. I mean, as we've said, though we're not huge fans of retirement, I hope you never have to retire. I hope you truly build an empire and you get focused on I can't wait to retire and more. I can't wait to continue building value and practicing this concept and doing things financially that essentially building a life I don't have to retire from. But nonetheless, we do feel that these are great reservoirs of capital that produce steady, consistent growth that we can pull from the policies to produce tax-free income. If you want to go take our beginner's course online, I actually have an example where we actually take real income from the policy and show you how all of that works. That wasn't really the goal of this episode. This episode was mainly just to lift the curtain around illustrations and show what do they do best. Well, what they do best is they help you see the window happening in real life. They see the most I can contribute. Let's say we're maxing out at 50,000, but I also have the right to drop it to 16. I can fill that window. I can see it. I can make a mental note of it, of actually what's happening. We can see that it takes time to capitalize the policy. So we see the typical trajectory of a normal policy and what to, real expectations to have inside the policy. But what we can't do with this illustration is you can't use this illustration to determine if infinite banking is right for you. You can't do it. You cannot use this illustration to determine which company is the best company to use. You can't do it. You cannot use this illustration to determine which company is the best company to use. You cannot use this illustration to determine which company is the best company to use. You cannot use this illustration to determine which company is the best company to use. You cannot use this illustration to determine which company is the best company to use. You cannot use this illustration to determine which company is the best company to use. You cannot use this illustration to determine which company is the best company to use. You cannot use this illustration to determine which company is the best company to use. You cannot use this illustration to determine which company is the best company to use. You cannot use this illustration to determine which company is the best company to use. You cannot use this illustration to determine which company is the best company to use. You cannot use this illustration to determine which company is the best company to use. You cannot use this illustration to determine which company is the best company to use. You cannot We wish you could, but you can't. All you can do is understand, hopefully by the time you get to the illustration, that nothing you see here will surprise you. It should all be understood. We should know before we get to an actual illustration a typical trajectory, a typical what to expect moving forward inside of the policy, and a typical growth pattern from company to company that look pretty darn similar. And another thing you can't really expect to see on here is infinite banking happening. That's why I say you can look at the illustration, but it can't tell you whether you should practice this concept. You have to decide whether to practice a concept based on whether you want what the concept produces in your life, not whether you think life insurance is a good investment. Because hint, hint, it's not. It's not even an investment. And we're not even telling you that you should invest money in it. We're telling you that it's a great place to store and save money, to build up capital, to achieve things in life. It's probably the best place we know of. We have total access to it. We love infinite banking. We love what they allow, the policies free you up and allow you to do, but we can't use the policies illustrations to determine whether we should do it or not. And so hopefully this has been helpful just to kind of see how an illustration operates, to understand what things to focus on, how they work, a typical policy trajectory. That was the main goal of this episode. And man, we love having you here. And if you are enjoying the podcast and want to kind of help us push forward the movement, the best way you can do it is through liking and subscribing, rating, give us a thumbs up, leave us a comment. All of those things are really the best way that you can help propel the movement we're in to make this infinite banking thing bigger and better than ever before. So thank you so much for being here. This has been Dollars and Nonsense. If you follow the herd, you will be slaughtered. For free transcripts and resources, please visit livingwealth.com/E204.
Listener, one last thing before you go. Start your journey towards financial security and wealth today. Visit livingwealth.com/escape the bank. Upon completing this course, you'll have all the information that you'll need to see if infinite banking is right for you. Again, go to livingwealth.com/escape the bank.